Good evening, one and all. Hopefully you didn't see me just close the door there with my jeans on. And finally, you get to see what I'm wearing underneath this desk, which is a pair of jeans rather than a suit. So good evening to you all. My name is Simon Misiewicz from Optimise Accountants. Hopefully you're well and having a good summer's day. Isn't it a nice change to have a summer's day compared to having all the wind and the rain and etc., etc. So I'm pleased to be live with you this evening. I've started just a minute early, so thank gosh for that. And I will be kind of going through our session. As normal, I will be doing this in 3 phases. Phase 1 will be through the in the news section, through the tabloids, finding out what they have been saying over the period of time. And then I'll be going into more to do with the FAQs from clients, finding out what they've been asking for in the last couple of weeks as well. And then finally, I'll be going into the Q&A that you may have as well. So good evening to you all, and hopefully you're doing all very well. In the news last week, I talked about the positivity that was coming out of the press, and I'm pleased to see that that positivity has lasted now 2 weeks. So maybe gone has the days. Am I getting ahead of myself here when I talk about the press being positive rather than negative? But let's pray it continues nevertheless. So that would be good if we could get them to be positives going forward. So I will be going through the what's been in the press now. So the first one, let's start with yourmoney.com. I will take a drink. It's quite warm today, as you could probably appreciate. At least I've not been sunburnt. So a couple of things that they were saying in yourmoney.com was the fact that there's been the biggest number of buy-to-let products since October 2017. That's right, 2017. So pretty much nearly 2 years now, and they've seen a surge of products in the marketplace for buy-to-lets now. It's 2,396. Let me just requote that. That's 2,396 buy-to-let mortgage products. That's insane. I mean, how on earth can you get 2,396? If I have a buy-to-let mortgage broker on here, I'll be delighted to know how many of those products they know. Because you always get this quotation from mortgage brokers saying, I do whole of the market. If that's the case, they've got to have pretty good knowledge of those 2,396 products, right? That's immense. One thing that they did talk about was in yourmoney.com, one of their articles was a 5-year fixed at 3.55%, 3.55% fixed rate mortgage. And I would say that, I'm just going to zoom this up so I don't have to keep looking down so much. I would say if you're getting that kind of mortgage, it's certainly worth getting that mortgage in place. I'm a firm believer that the mortgages that we have in place right now will indeed be increasing over time. They certainly won't be staying as they are at the 2, 3, 4%. So I think they will be increasing. So getting a rate of 3.55 on a 5-year fix, that is phenomenal. So just out of interest, if you can type in the live chat, as you can say hello to me, that would be nice. They say hi. But equally, what kind of rates are you seeing on the buy-to-let mortgages at the minute? Are you seeing rates of 2%, 3%, or 4%? Last week, I talked about TMW and how and by the way, I'm not a mortgage broker. I'm not giving you financial advice. This was just what was reported in the press. But they talked about TMW last week and their rates on limited companies being 2.89%, which is phenomenally lower than I could have ever anticipated. I used to say, don't always get a property inside a limited company because the mortgage interest rates are going to be phenomenally higher in a limited company. But that's just proving me completely wrong last week with TMW coming in at the rates that they did. So good time to go into fixed term mortgages. Coming back to what yourmove.com was talking about, with the rates of being 3.55, being fixed for a 5-year period. I certainly would go with that if you can get that deal, because the interest rates are likely to go up. So I would be tying down my fixed rates now, just to make sure we could do that. And I've got a good mortgage, so I'm not going to change mine, to be fair. I'm pretty happy with my portfolio mortgages. But moving on to buy association. Buy association was talking about Section 24. Who isn't? So mortgage Section 24 is mortgage interest relief cap, and that means that we're in the second stage now of 50% of your mortgage interest being allowed, and not the other 50%. We're currently in, obviously, the tax year now, 1920, which is the third instalment. So when you're doing your tax returns, you'll only be able to offset 50%. In this tax year that we're in now, we're only allowed to offset 25% of mortgage interest costs, and then the rest of the 75%, you would get a 20% tax reducer on the mortgage interest payments that you have. And they had an interesting insight to say, and this is by association, by the way, that by association news press was talking about buying properties up north. I always find it really odd to say up north. I feel like I should say it in a Yorkshire accent or something, you know. But up north, as I've just said, they suggested that buying properties in Manchester or indeed Liverpool would be a good idea. And I would agree with that. We are seeing properties in London starting to wane because of Brexit, fear. There's not a lot of movement with properties down that side of things because the value placed on them. We've also got this buy-to-let mortgages that people are looking to move on as well. So it's not always the best thing to be investing into London. I've just caught myself, and I'm looking at the camera kind of odd now, because down just below this camera, you can't see this, but I've got myself being reflected back on me, and I've just seen myself scratching like an ape. So forgive me for that. I'm going to keep my hands on my lap like a true newsreader to save myself any further embarrassment. So where was it? Yes, I was talking about Section 24. Everyone's writing about it, using a limited company and then buying up north. And I would agree with that. The fact that the capital increase in property values isn't likely to go anywhere anytime soon, apart from northern areas. I would also say the return investment in Manchester, Liverpool, which is what was cited in this press, was right as well. So this is by association, online magazine, and I would agree with them. I think that looking further north would be a better opportunity for investments in the long term as well as the medium term. Short term, I would kind of look at other areas other than Manchester and Liverpool, and the reason for that is because there is an oversaturation in the HMO market right now in those cities. So I'm finding the same in Coventry as well. There is an oversaturation. I speak to my clients quite a bit in terms of what's happening in the marketplace, and they're saying that there's squeezed margins in those cities, and I think that's going to be true of most cities as we go forward. HMOs are going to be saturated. Reason one is HMOs are more lucrative, and we've got more property investors. We haven't got as many landlords, and that's why I'm differentiating from this, is that you've got property investors who I think are the ones that are proactively looking to invest, and landlords that are looking at their portfolio and trying to dispose of them. So that's my terminology clarified. So property investors, there's a lot more of them investing in HMOs and saturating the marketplace, and then we're going to see that across most cities in the UK. We're also going to see a saturation, I think, in the holiday lets as well. And interesting enough, there was, let me just finish off this point actually. So, no, I'll move on. There was one press article that talked about, let me just have a look where they would sit. Yes, so this by association, yet again, another piece of article that they talked about was buying in holiday lets as opposed to just normal standard single let properties. and they quite rightly, they identified the need for a property, if you want a holiday let, to be available for 210 days, and then to be let for 105 days. And that is the only time that you could have that property being called a holiday let. It has to be physically let out to guests for 105 days. If it meets that criteria, then the mortgage interest costs will not be affected by Section 24, which means that holiday lets can have all of the mortgage interest costs offset against its income. Whoopie-doo, that's a positive news in itself. But you do need to be very, very careful to prove to HMRC, especially because of Section 24, that it has been available for these 210 days and has been let out for 105 days as a minimum. Because if you cannot prove this is the case, then they would be vindicated that the property is a property investment, and therefore Section 24 applies, and mortgage interest costs would not be allowed to be offset against that property. So please make sure that you do your due diligence and you get your administration in order to prove that it's been on Airbnb, Booking.com, or whoever you might be using to say it's been registered, it's been made available for that 210 days. And here is the proof by having records of, maybe using QuickBooks and Xero will allow you to do this, of the bookings that's been made for that property. And that will allow you to get away from mortgage interest relief clause 24. I just thought I'd mix that up because normally people call it Section 24 or clause 24. So I'm not sure where you're sitting. What do you call it? Just type in just in the box. What do you call this mortgage interest relief cap? Do you call it Section 24? Or do you call it clause 24? Please type that in the comments box. I'd be just really interested to see what people are calling it nowadays, because I've always called it Section 24, never called it clause 24. But maybe I'm wrong, and maybe I should be changing with the times and calling it just that. A couple of other things I always talk about was that if you are going into this holiday let, make sure you do your research using Airbnb. There's some great resources in that. You couldn't have, for instance, an Airbnb product in the middle of a housing estate that doesn't have transport links and no restaurants, no entertainment, no nothing. That just wouldn't work. So you do need to work out, if you are going to convert some of your properties to a holiday let, then you ought to do your due diligence. Make sure it's in the city or a town centre, or good transport links to the hospitals, or for the doctors, consultants typically, or to big businesses, that people that work Monday to Friday and can't be bothered anymore to sit in hotels. Make sure that you speak to your mortgage broker as well, or your mortgage lender. A lot of people are converting their properties from a single let product to a holiday let, but not really informing the banks, and yet the terms and conditions of the mortgage will often say it's a buy-to-let, it's not commercial. So you do need to make sure that you're above board, working ethically, and informing your banks of everything that you're doing on with that. I keep picking up my hand at a bottle and not drinking anything. My personal trainer has been saying I have to drink lots more water. So Aaron, if you're watching, here it is. I've nearly choked myself. Trying to prove him wrong there. So the other side to it is make sure that you contact your local authority. Your local authority needs to be aware that you want to convert your property to a buy-to-let. That's Aaron in the helicopter in the background, if you can hear it, just flying by, trying with his binoculars, seeing if I am truly drinking my water. So this is where just going back to the local authority, back to seriousness now. The local authority will need to make sure that your property can be converted to a holiday let. The reason I suggest that is Newham in London were the first local authority that I'm aware of that prevented a normal standard residential units being used as holiday lets because of the noise pollution that was potentially being created for the normal residents in the area. So they said no to that kind of thing. And I think that's gone across London now as well. So you do need to check out that you can be fined for not getting that if you kind of go against their wishes of not using your property as a holiday let, so make sure you do your checks for your local authority. And that was pretty much that. Let's have a look at something else. Just looking through. Okay, so, I'm not going to talk about that. I talked about that last time. So Metro Bank was talking about the lenders. Many of the lenders are scrapping, and wait for this, because again, something I'll be interested in your views about in terms of discrimination against DSS tenants. Metro Bank was talking about they're scrapping the ban of landlords and property investors from renting their accommodation, their properties to DSS tenants. And I was surprised to read this, because it was, well, it's discrimination. Surely banks are not allowed to get away with it. Surely the government should be stepping in to say you're not allowed to do it. The only reason why they're changing it so you can let out your properties to DSS is not because of legislation changes or the government enforcement. It's because of competition. And I kind of think, who is running this country? The government are always kind of sticking their boot in when it suits them, I guess, in terms of saying, well, people shouldn't act in a certain way. Yet banks have been getting away with discrimination for a long, long time. Now, I appreciate that it's business and you've got to do what's right, but equally, surely that's up to the landlord, not the mortgage companies. And I appreciate you've got to cover your risk, but then maybe charge more interest if you're going to do that. So I don't know. I just find it bizarre that mortgage banks are allowed to write this into their criteria. And more importantly, were you ever aware of your terms and conditions where it says you cannot lend to DSS tenants? Because in all the years I've been investing, I've never really looked at the details too much to find out that I've been banned to rent my properties out to DSS tenants. So again, an interesting one. I mean, have you ever, maybe write in the comments box below, have you seen this before? Is this new to you, that Metro Bank are the first one to scrap this ruling of DSS tenants? Or are you even aware of it? Because I find it really bizarre that this should be allowed. But anyway, that's just my view, but I'm just totally gobsmacked that it should work. Interesting enough, I saw that people are talking about Section 24, so I appreciate that. Yeah, good. There's a question in terms of, I'm trying to pronounce this, Vergai. You're asking about properties. I will try and come to that, but that looks a lot bit of a more complex question. Vergai's asking, what's the best structure of properties valued at 1 million, want to leave properties to 4 kids who are adults and min inheritance tax, currently trade as partnership rental businesses, want to transfer to limited company? To be honest, that's a great question, but I honestly will not be able to answer that on this call. It's so detailed, and if I get this wrong, when based on your personal circumstances, I could be sued pretty quickly on this one. So if it's a good question and it's kind of generic, fine. This is really specific to your situation, so I wouldn't say that. I'll try and answer it in general, but I think in terms of going through that might be a bit tricky even for me. Just going through other things, the properties. There's a magazine, online magazine, of course, Property Reporter, that was saying Britain could be hit with a housing crisis, all because the landlords that used to be rented to their properties to tenants are now no longer there. And where do these tenants go? Well, that's a very valid point, isn't it? And yet the government can't seem to recognise this. And I always find this fascinating, that you've got the housing minister that's saying we need more houses, and yet the other side to it are the leaders of these government parties and saying, yes, but we need more tax and we need to push out these rogue landlords and actually landlords as a whole, quite frankly. So yes, I understand your need for housing, but we don't want these landlords ever again. So we'll stuff them with legislation changes and tax changes. And the Housing Association are now baffled by all this, because they're now saying, but we probably need to ease these tax changes, because we're fearing that we've now got maybe 400,000, 500,000 properties coming back on the marketplace, being sold and empty with no tenants. Where are they going to go? And that is a great question, and the RLA was cited in the Property Reporter, and I completely agree that yet again it just shows the inability for people to run this country properly, and that's not just one party. That's the Conservatives and the Labour Party, in my view. Just the fact that we know there's a housing crisis, and at the same time, let's stick our boots into landlords. Crazy. I mean, what's your thoughts? Do you think there's generally a housing crisis? And do you think that the government have gone too far in terms of trying to get some tax out of landlords? And not just tax, are we? But we talk about legislation changes as well. So what's your thoughts? Maybe drop that in the comments box as well as we go through. Buy Association, another online magazine, talks about it's hard to see landlords maximising their returns. So there's a lot more. Oh, I talked about this holiday let, so forgive me, I've just repeated myself here. Let's move on professionally, as I try and do that with my embarrassed look in my face. The Money Expert talks about the House Resolution Foundation found that 5.5 million people in the UK, around 10% of the population, own a second property. Wow. If that is the case, okay, so property wealth, owning a second home has risen from 610 billion to around 941 billion today. So that's second homes in this country. My first thought was, has HMRC noticed that? Because, forgive me, when they talk about legislation changes and tax changes, they always target, in my opinion, the good landlords and the good property investors. They enforce all these legislation changes, whether it's HMO licenses, tenant fee bans, etc., and tax changes to it as well. Now, my view is, when I attended a local authority meeting, and I'm not going to name it, just to prevent any issues there, but this particular letting agent, local authority, said that they are going to enforce these HMO licenses. They're going to push in standards licenses, landlord in license as well, so there's an extra £500 there. And someone stood up and said, well, that's all fair and well, but what about the rogue landlords, the ones that aren't like us and happy to, well, not happy, but will adhere to the rules and regulations? What about those rogue landlords that keep their head below the parapet and still rent out properties and don't pay your license fees, don't pay your landlord license, and don't pay those taxes because they don't even tell HMRC? And the honest answer they came out with was, oh, we expect you to tell us. And everyone in the room, including the person asking the questions, just laughed and was baffled. Just goes to show, yet again, that they don't really think about, let's get the people that aren't honest and support those that are honest, giving good homes to tenants. And it's really just a really interesting insight to the way that their heads are in terms of, well, let's from their viewpoint, let's make tax and legislation for the ones that are doing it right, because at least that's some money, rather than thinking, well, it's time that we kicked out the rogue landlords that are giving real bad service to tenants, which you've probably seen on the TV. But they're not going to do that, are they? They're just going to, get rid of landlords that do care and leave the rogue landlords that won't pay tax, won't pay these license fees, and then tenants have got worse conditions than ever before. And if it's not worse conditions, even maybe having housing crisis, as the previous publication said, and have homelessness instead. So I just find it baffling the way that this government's run. And I did promise myself this week that I wouldn't have a rant on this YouTube channel, but that's exactly what I've done. So apologies for that. But, I'm really passionate about helping landlords save tax and create wealth. But I find it a farce when I find governments acting the way they do. So Now, we need to do something about this. So if you are part of the NLA, National Landlords Association, or the RLA, then I think you should start to get together with those organisations and start fighting the government back. It's time. We should have enough by now. Not just the tax changes, but the legislation changes, and say enough's enough from this government. If you need to focus on Brexit and getting that right, and getting this country into a state that's not laughable, which it currently is, which is, a leaderless society that we currently live in, which is ridiculous. So let's just go in terms of what clients have been asking for, and I'm just going to go to questions that have been asked by our clients, so just bear with me a second. So this is stuff that our clients have been asking for as opposed to anything else. And interestingly enough, it was talked about, one client was asking about, oh, by the way, if you do have any questions, make sure you feel free to type those questions into the box below. And I will come to section 3 shortly. It's now, what time is it? 7:25. So I will be looking at your questions later on. So keep typing them in as we go along tonight. It'd be fantastic to get those answers to you. And Fargi, by the way, just because I said I can't answer your specific, I will give generic stuff, which it would be useful to everyone listening in. If you want more details, then I would say book a tax call to make sure it works for your circumstances. So I will do my very best tonight for you. So feel free to type your questions in. I will be coming to those, and I will be answering them all in tonight's session. So let me talk you through the common questions that have been asked by our clients. Every week, we give our clients free time with us. They can book calls with us anytime that they like, when it's convenient for them. And we ask them to upload their questions, and then we, in the mornings, well, not we, I don't do this anymore, but my tax advisors will look at the questions, do their planning in the morning, and then when the call is there, it's all about solutions. So we're not taking up time from our clients in their busy day. We're really helping them with true solutions. So that's our approach, and this is the questions that's been set. 3% SDLT on second homes, which is a real interesting one. So this is whereby you have a second property in your own name. And the common question is, do I have to pay 3% SDLT surcharge when I've got a home and I buy a new home? And the answer is, well, yes, if you do not sell your current home as part of the transaction, then you will have to pay the 3% SDLT surcharge on the new home. Now, you can claim back that 3% SDLT surcharge, provided that you sell your previous home now within 36 months. So if you sell your current home as part of the same transaction of buying a new one, no 3% SDLT surcharge. If you do not sell your current home as part of the process, then you will have to pay the 3% SDLT surcharge, but you can claim it back if you sell your previous home in 36 months. And the other side to it is, if you are buying a buy-to-let property investment inside a limited company, even though it's got no buy-to-let investments at the minute, you still have to pay the 3% SDLT surcharge. So that's a problem that you're going to have. Equally, if you have a buy-to-let property investment in your name and then you buy a home, you will still have to pay the 3% SDLT surcharge because you've already got a house in your name. The fact that you're buying a home, it is your second property, and therefore the 3% SDLT surcharge will apply. So you do need to be very, very careful about this 3% SDLT surcharge. And many people are asking, well, should I, I've got sentimental value to this previous home. It's meant a lot to me. I've got memories. And as I said in my property tax workshop that was held in Nottingham this Saturday just gone, one of the things I said was, leave your sentimental memories in that property and sell it. It is, as soon as you move out of that property, that's no longer your home. Okay, someone else is going to be living in it and changing it to meet their needs. It's no longer your home. So forget it. It's not sentimental value. If you want sentiment, then go around the property, not in it when you don't live there. That'd be wrong, wouldn't it? I'm just coming in just to see how, just to bring back some memories of when I used to live here as a child. I think you might be arrested if you did that. So really don't do that. But if you have sentimental needs, drive around the local area of that property, drive around the property, again, not looking too snoopish, but don't look at it as I need to continue owning it, paying this 3% SDLT surcharge, and this property as now an investment is probably generating absolute rubbish return investments and may not even have the capital growth opportunities either. So I personally would say ditch it, move on, sell the property, okay? So don't pay the 3% SDLT surcharge. On that basis, one of the things I said was that there are times when you've got SDLT and reduction. So we're talking through quite a few clients this week about SDLT reduction. And one of the things that we talked about was that SDLT is based on the bricks and mortar of the property. So imagine that you've got a property, and I'm going to talk about a property that's lower than the 125,000 SDLT tax band. I'm going to give the value of 100,000. So this property is £100,000. You've got a buy-to-let property investment already. So therefore, you are going to pay the 3% SDLT surcharge on the full £100,000, which is £3,000. Now, if you're going around the property and you agree with the seller that they're going to leave all their goods and stuff like that behind, and you agree that the furniture, the fixtures, the TVs, you name it, those kind of stuff that they want to leave behind, maybe because of downsizing, is worth, let's say, £10,000. It's unlikely, but if it was worth £10,000, then SDLT would no longer be based on 100,000. It would be based on 90,000. So there's a £10,000 saving, which you would pay the 3% surcharge on, which I appreciate, right? We're not talking about mega bucks here. We're talking about £300. But if you did that across a number of properties, it's easy money to be saved. And it gets worse because if your banding does go above 125 or £500,000, you've got 3% SDLT surcharge plus the banded rate. So if you can reduce your property value of the bricks and mortar by something called chattels, that's worth noting this one down, is chattels. And chattels is the fixtures and fittings of the property, which isn't taken into account when looking at SDLT, then building that chattel value up would be a good thing. Now, you do need to have an agreement by the seller to say how much it's worth, and the solicitor to say, well, I'm putting my name against the SDLT calculation, don't take the mickey, okay? So it has to have a commercial value, but it is a way to reduce your SDLT, and it's something that's relatively easy to do as well. So it's something for you to bear in mind as you're going through it. I also want to talk about holiday lets and the fact that there is VAT on that. And we have a couple of questions, as now that we've got this whole thing of holiday lets, Airbnb products being put on there. Let's just talk about holiday lets in general here. Yes, we know based on my previous comments that a property needs to be let out for 210 days. Sorry, it needs to be available, correction, needs to be available for 210 days, and the property needs to be let out for 105 days, which you need to prove to HMRC, then Section 24 doesn't apply. We know that. But what we haven't really established is VAT, value added tax. You see, VAT would need to be charged if you look back at the last 12 calendar months and the rent as a whole, not your rental properties, but your holiday lets. If you added up your holiday lets and it was above £85,000 in terms of income, then you would need to be VAT registered, which then gives you a problem, doesn't it? Because you've got this situation whereby you might charge £100 a night, but all of a sudden you've got to charge VAT. So it's either you charge VAT at £20, so that your prices have now gone from £100 to £120. Will your customers like that, or will they shop elsewhere for something cheaper? The other side to it, if you have to charge VAT, is that you may decide to suppress your prices so that the end tenant doesn't have to pay any more than £100, but it means that you may be only now charging £84 for your particular deal, or that's what you're getting from a gross value. The rest of it has to go to HMRC. So there are things that you have to consider with holiday lets, and albeit there is this thing called flat rate VAT as well, which we need to consider. So, when you get this, let's say you charge per night, you're VAT registered, and you've charged a guest £100. Now, of that, you've got VAT on top of it, so there's £20 VAT. Their total guest stay value is £120. So £100 stay plus the £20 VAT, £120 in total. Typically, you would have to have that £20 paid to HMRC less any items that you've acquired that had VAT on it. Now, whichever way you look at it, that could be quite high as a percentage. So what HMRC allow you to do is introduce something called a flat rate VAT scheme. And it's discounted by 1% for the first year as well. So the first 12 months, you would say £120, and I would look at 9.5% of that 9.5%, and I would pay that over to HMRC. And it's really then for you to decide whether you want to go on flat rate VAT scheme or you want to go on standard rate VAT scheme. And there are workings around that, and it's probably worth you looking at booking in time with your accountant to really work that one out. It's not the easiest thing to decide upon because you need to do forecasts forward. And the big thing for you to consider as well is the type of tenants that you may have as well. So if you've got tenants that are working in corporate, they will be able to claim back the VAT. So maybe that's not such an issue anyway. But if you've got the average Joe consumer, you and me, we wouldn't be able to claim back that VAT, and it would be a concern. So you would have to either drop your margin or we might shop elsewhere. So something for you to consider. The one big thing on flat rate VAT, by the way, is if you've got all your properties in a limited company, in the same company, then the flat rate scheme would be based on all of the rental income, even the residential rents, which are typically VAT exempt. But in flat rate world, they are taken into account. So you need to be very, very careful in terms of the flat rate scheme and whether you take that or not. So let's just go, we talk about limited companies. Again, one thing I want to bring to your attention is something I said last time around, funny enough, is should you use a limited company? This question, yet again, is being raised several times over with clients. Maybe we should do a piece on it just to prevent the question coming in, but I guess it is a common question. Just a bit of a stretch for a minute. So the limited company, I would always say, what is the purpose of that company and how long do you need it for? Many people are setting up limited companies because of Section 24 and the fact that they are a high rate taxpayer. And if they wish to be a high rate taxpayer because of their job, and that is likely to persist for 5+ years, then I would say using company structure might be correct. However, we are seeing clients that after 2 years of being an employee plus building up their property portfolio inside a limited company are now turning around to it saying, well, I'm actually going to give up my job. What do I do with this limited companies with properties inside of it? We're thinking, well, nothing, you can't do anything. So there's a little there's nothing, this fly is just going round and round with my light. So I do apologize if I'm just looking around. Basically, the properties are still in the limited company. You can't just unencumber them or move them back into your own name without a tax charge. So once they're in there, you're stuck. So it's back to planning and having the end in mind. If you're thinking in 2 years' time you might be giving up your job, then my honest opinion would be, well, pay the extra tax that you're going to have in your personal name because of Section 24. But don't set up a limited company as a mitigation factor. But you may as well keep it in your own name. And then after 2 years, you may be a basic rate taxpayer and paying less tax than you would be owning a limited company anyway. Coupled with that, we had a couple of clients that are saying, well, I want to set up a limited company, but I want all of the money out of that company for my lifestyle needs. And honestly, guys, if that's the case, where you're not, let's imagine you have £100,000 worth of profit after tax, and you need that £100,000 out of the company for your lifestyle, you're going to end up paying a lot more tax, income tax wise, and corporation tax than if the properties were in your name. So do be careful when setting up limited companies. We've seen too many clients of ours booking, buying limited companies and not really thinking about the long-term plan. They're just looking at the immediate Section 24 problems and then trying to create a mitigation plan. I'm just going to go to the other questions that maybe we do talk about incorporation now, because and apologies, I've screwed up your name last time, so I'm going to get your name properly there now. So Fergai, I believe it is. Fergai, let me know if I've said your name right, because if I haven't, then I do apologise in advance. By the way, I'm trying to do my best with that. Let's talk about incorporation of property portfolios. I know Fergai's asked a question about, should you go into a limited company and partnership agreements, and so again, some of these things are generic, so I can talk about them in generic terms. I'm not going to give you tax advice for you specifically, because if it turns out wrong, straight away I'm in court, and I don't really want that, to be honest. I don't really like courts. I don't think I've actually been in one talking that, so I'm not sure if I like them or not. It just sounds like I don't really like the feel of it, sort of going to the courts. But anyway, so the incorporation is all about Partnership Act 1890. The Partnership Act 1890 stipulates if you are a business, a trade business, then you can incorporate your properties into a limited company and not have to pay capital gains tax and SDLT. The Ramsey case in 2013 was pretty much echoing that. The judge resided the fact that the Ramsey case was all about the couple in question was working 20 hours. By the way, I'll talk about that 20 hours in a second. But this particular couple was working with the tenants directly. They weren't working through a letting agent. They was managing some of the refurbishments. They were collecting money. They was doing things with the tenants, basically. Sounds really bad, doesn't it? I might have to rephrase that. They were managing the tenants. How about that? That sounds a lot more professional, right? There's no innuendos there. So they was managing their tenants rather than doing something a bit dodgy. But with that in mind, the courts resided that it was a trade business after all. So therefore, the incorporation could go ahead and not have to pay this SDLT or CGT through a partnership route. And a couple of things that I would say is that the Partnership Act 1890 stipulates that there's got to be 2 or more people with a view to make profits. That's first of all. So they've got to be working in the partnership. They can't be just seen to be there. They have to physically be doing something in that partnership to make it a success. A couple of things I would say is that you need a partnership. Now, whether you use a standard partnership or an LLP, you need advice on that. But the partnership needs to be in existence for 3 years. And then in that time, you can pretty much decide at the beginning of the partnership how the profits are split between the partners. Okay, so you have a capital account, how much money you've invested into the partnership, but you also have this profit split as well. There are other things that we could talk about, but no, I'm not going to talk about all night. And then after 3 years, you would then go from your partnership, you would refinance your properties into a limited company, and then you've incorporated all of your properties in this entity. And then, hey presto, Section 24 doesn't affect it, and away you go. There are things you can do with inheritance tax planning in terms of growth shares and sticking things in. Now, we've talked about that extensively in our course on Saturday, and I'll end up doing that bit more detail on that in our course in September in London, which I've just got to finalise the dates on. But it's, like I say, it's pretty much a good hour section in its own right. So I won't be talking about that tonight. But there are plenty of things that you can do in your limited company, not just for IHT purposes. Now, you do need a good partnership agreement at the outset as well. So not only do you have to register the partnership with HMRC, You also need to have a partnership agreement in place that specifies the capital and the percentage profits allocated in that partnership agreement. It needs to be clearly shown that it is there to make a profit. So that is the big thing I would say to you all, is make sure you do enough planning on that. Don't scrimp and scrape going onto Facebook forums, LinkedIn, and trying to get a couple of things to yourself. It will cost you big if it goes wrong. So make sure you get it right. There are things like latent gains that you need to think about, which is the difference between the original purchase price of a property and then the mortgage value. So let's imagine you've got a property that was worth £100,000 when you purchased it. It's then £200,000 and you refinanced it, let's say £150,000 mortgage. You've now got a latent gain of the difference between the £150,000 mortgage plus the original value of £100,000. That's £50,000. You've got a latent gain now, and you've got to pay that 18% as a basic rate taxpayer or 28% as a high rate taxpayer when you incorporate your properties, because it's a disposal. So you will need to pay that CGT. So hopefully, I've answered your questions in generic terms, and hopefully you've got some insights on that. But I think, looking at your questions, I think you can certainly do that. Share structures, I would probably set up a company that says an A-B share for husband and wife, or partner and partner. And then children should have a C-class growth shares with a value of 1 pence, which will have no value, no distribution rights, no voting rights. And then over time, it's written in its particulars that the certain values would go over to that C-class share to try and help you mitigate section 20, to mitigate IHT. So hopefully that's answered the question, because you do say, how does it mitigate SDLT? So I've answered that. And you've also talked about your share structuring your 4 kids. Hopefully I've done that. One comment I will make is that there are a lot of people that are setting up limited companies. And we've seen this by other accountants, and I'm not going to have a dig at my own profession. But this particular client in question had their 4 kids. No, sorry, I'm thinking about you now. They had 2 kids, and they were a husband and wife. But this company was set up with the 2 kids as 25% shareholders. And then they went to get a mortgage, and the bank said, who are these kids who are minors on your share particulars? We're not lending to this company when you're minors. So they had to reconfigure the whole thing, and basically the 2 kids had 1% of the company value. But it then later proceeded that they was paying them minors dividends, because their accountants said you could do that. Well, no, you can't. If your company, which is your company, is paying dividends to your children who are dependent minors, then that income from your company will be based on your tax position. So it's amazing how many times people have been ill-advised on this. And this is what I'm saying. You have to be really careful, not just on Facebook, LinkedIn things, but also accountants that really don't know law properly. So you do need to be very, very careful with that, and get good tax advice at the planning stage would save you thousands of pounds of when it goes wrong. And literally, it does. So let's just go to the questions now, because this is your section, and it's already 10 to. Wow, little time go by. I've just done the scratch like an ape again, so I'll move my hands down. Let's have a look at, so section 214 perhaps is the correct term. Thank you, Mohammed. Thank you for listening to me tonight and pointing that out to me, because I'm pleased I've been saying that, but clause 24 has always been there, hasn't it? Not sure why. Lloyd's asked the question, if you had £250 to spend on a property to rent, what would be your strategy today? That's a great question, Lloyd, and interesting enough, I've got one for you, and that is to look at commercial properties. We were talking about this on the workshop over the weekend, whereby I might look at a commercial property because I want to avoid SDLT. I might look at doing a property development whereby it's converting a dentist, which is, so now when you go into a high street, you always find this dentist or accountancy firm that is amongst all these other houses. And it probably is the same, right? It looks the same. And even the interior, I would argue, probably is the same. It's just got offices built for, you know, rooms for offices or dentistry chairs. And my view on that is that if you're buying a dentist or an accountancy company, well, the building, it will be non-residential rates. And if I then converted that commercial building into residential, and there are some caveats and terms, you've got to be very, very careful about this, by the way, so don't just jump into it. There are many, many conditions that you need to apply, and that's a case-by-case basis. We can help you with that. But if you meet all the terms and conditions, you can then convert that property from commercial into residential and only pay 5% VAT on the conversion. And again, there are issues with that as well, but it can help you reduce SDLT and VAT immediately. So I'm always looking at ways of minimizing my tax bill. Now, you talk about what my strategy might be. I would equally buy that in a limited company because I don't want Section 24. So where would I invest 250K? I would probably put my money into a limited company, do some conversion projects because I want to save VAT and stamp duty, and make micropods. So micropods is a big building, so it could be an office, and instead of HMO, which could be quite noisy and disruptive to my life, never mind the tenant's life, I would go with self-contained units, and that way I can make them soundproofed. I can make, and I did funny enough, a recording on this, which I've got to do again because my recording studio buggered up. But I'm doing a video which could be launched in 4 or 5 weeks, probably on a Thursday night, which we always do. So again, if you haven't subscribed to this channel, please do so, and then make sure you press the bell notification so you get your reminders of each time that there's a video being uploaded. By the way, if you're happy with what I'm saying tonight, or if any part of this is useful, please do me a favor, because I am trying to get out there. I am trying to promote this. I want to kind of make this worth my while, and a bit of an ego trip, but press the like button if you find this video useful. It helps me with the rankings. It gets me more audiences out there, and hopefully we'll get so much more interaction because I'm getting more questions coming into this forum as well, which gets my thinking brain going on, and then I can provide you with even more answers. So it makes it a bit more interesting. So please press the like button if you find this interesting. Does my ego brilliantly, not lying to you, but equally it gets our name out there a lot better and makes this a lot more enjoyable if there's about 50, 60 people online. So Lloyd, hopefully, has that helped you, Lloyd? Please feel free to type in terms of if you've thought about doing. In fact, I'll ask you all a question. Who in listening to me now has thought about investing in holiday lets? If so, type in yes. If not, don't worry. Equally, are there anyone else out there thinking about investing in commercial properties, whether it's to use commercial properties full stop, or looking to do commercial to residential to save themselves SDLT as well as VAT? If you have, just type in the word yes in the comments box, just so it acts like a poll, and we can see kind of where we're all headed in terms of our property investments. I will say this: I do think that single let property investing in your own personal name is dead. So when you see articles about buy-to-let is dead, yes, I agree, and no, I don't. Yes, I agree that single let buy-to-let investments is probably the thing of the past if it's owned in your own name. I do think, however, there is plenty of scope to make lots of money if you use a limited company wisely. And I mean wisely, not as in using a company just to extract all of the money. So hopefully that's that. But hopefully, feel free to type your questions and comments down below. I'm just going to have a look because I do sometimes miss that there's lots of questions coming in. Good to see Jeremy back. Jeremy, you're back in the foray. You must be glutton for punishment coming into our sessions, but it's great to see you, Jeremy. Great name, Clotus or Cletus. I'll have to be careful how I pronounce that. But Cletus has said, how do you claim back your director loan from a limited company that you have set up to buy property outright with your own money and let out? Well, to be fair, Cletus, that's a great question. If you have put into a limited company £100,000 and that limited company should just so happen to buy property investments, that is a debt. And the repayment of that £100,000 to you can be done any time, provided clearly that the limited company indeed has got the money and the funds in its bank accounts. But if it does pay you back that money, there is no tax implications for you. It's not earned income, it's just the repayment of debt. So don't worry, Clayton. If that is the case, you've got some money in your company, just pay it back whenever you want. There are no issues with that. I wouldn't go ahead and start charging the company interest, which is what some landlords are doing. The reason for that is because you've got this administration requirement of a CT61, which is a quarterly return. And it is only a tax liability for you runaway. So I personally wouldn't do it if I was you. So hopefully that's answered your question. And he said, can you change the interest to your company or charge interest? Well, I didn't even read that, please, but I personally wouldn't charge interest to your limited company. Just don't do it. There's a CT61 and it's going to be an absolute nightmare when it comes to your tax return because you are also now got a tax liability. Jeremy, great to see you, Jeremy. So you asked a question, if your rental properties are in LLP, would you still pay SDLT surcharge on a second home? That's a good question, actually. So an LLP is a company structure. So companies would normally pay 3% SDLT surcharge anyway. So the answer would be yes there. And if you had a second property in your own name, just so happened to buy an LLP, you'd still pay 3% SDLT surcharge. So I think, Jeremy, that's an easy yes, unfortunately. I'm turning all my BTL into service accommodation. Interesting. Hopefully you've heard me talk about the service. So by the way, service accommodation is an interesting term. It's people sell courses, don't they? And it's, you know, for service accommodation. And to be honest, it's no different to rent strategies. And people will always say to me, well, you know, rent-to-rent is not subletting. And I kind of think, well, what is the difference really? You are technically speaking renting from one person and then renting to another. That is, you know, subletting, isn't it? From a legal point of view, even from a common sense point. And people say, no, it's rent-to-rent, it's different to subletting. And holiday lets are the same thing, right? So people now saying it's service accommodation, it's not holiday lets. Really? Okay, so the terms from HMRC, there is nothing in their legislation for service accommodation. There is everything to do with holiday lets. So you go figure. Is it holiday let service accommodation? By the way, that Jeremy, you know me by now. This is not a dig at you, my good man. But it is just interesting how people come up with newfangled things to sell courses and sound exciting and fashionable. But ultimately, it's the same, right? Just to answer that question, well, not question, but to come on to that, it's good to see that you are investing in these type of properties. And I would endorse, if you're doing it right, then it's something that you should be looking at. I'm even thinking about doing holiday let service accommodation, call it whatever you will, because there's more money to be made if you do it right. I would say that you need good systemization to do it. So in terms of cleaning and making sure that's done, checking in, checking out processes, making sure that's systemized. Don't take up your time. Don't create another job that you don't really want to do. A lot of property investors and landlords out there, in my view, they've exited their jobs, which they kind of, 60% don't like, 40%, well, there are some times I like it. Then they go full time in property, and then within 5 years hate it and wish they never did it. So do systemize your business and treat it like a business when you're doing property investing, and get other people to do it. Make sure you delegate almost straight away. And I appreciate there are fees and charges away with that, but don't create yourself a job that you end up regretting in the future. Clecia said, do I still pay corporation tax on the profits? And the answer to that is you do pay corporation tax on the profits made in a limited company. So yes, that's true. You will do that. Okay, just seeing if there's anything else that I need to go through, because I always miss my chats on these things. So I don't think there is anything. Wow, this is the first time that I feel that I'm getting on top of this this system. So I'm pleased about that. So thank you ever so much for that. If you've got any questions, I'll probably stick around. But don't forget, on Thursday evening, I will be launching a new video And I did say I would find out what that video is. And I think it's actually about capital gains tax. So if you are looking at capital gains tax and selling properties, that video will be worth watching, and that's this Thursday evening. And don't forget, I will be live here again next Monday at 7 p.m. Tell your friends, share this event, like the page, like this video. Guys, help me out, because the more we get people on board, the more questions you've got. And do you know what? I will stay on this video until I've answered your questions. And that's even if I'm there till 11 o'clock. So I made that solemn promise as much as I can. The more people I've got on board, engaged, asking questions, then I'll be delighted to answer your questions. First, guys, ask a question: if a limited company sells a property, say for £100,000 and purchase cost was £60,000, do you pay capital gains tax, corporation tax, or capital gains tax, CGT? And in a company perspective, it's pretty much the same thing, to be fair. Corporation tax currently is 19%, by the way. In April 2020, it will be reduced to 17%. The reason I'm saying that is because the company, it will pay CGT, but it's based on corporation tax rates. So there's no real difference. So, Fergal, I think that's answering your question. So if you had a property, you sold it for £100,000, you purchased it for 60, you made £40,000 worth of profit, you would pay 17% corporation tax on that. The interesting thing about that is that as a basic rate taxpayer, do you know your capital gains tax rate is 18%? As a high rate taxpayer, your corporation tax rate would be 28%. And if you're selling property at £40,000, I rather suspect, yes, you guessed it, you would be a high rate taxpayer paying 28%. I appreciate you do get a CGT annual allowance in your personal name, which you do not get in a limited company. So there is a yin and yang. So just so you're aware of that. Jeremy is also saying, thanks, Simon. Looking forward to seeing you on Thursday evening. Be there or be okay. So thank you ever so much, guys. There's no other questions coming in. So thank you ever so much for joining me tonight. It's been enjoyable as much as anything else. And I will see you again next week. Make sure you press the like button. Make sure you press the subscribe button and the bell to be notified every time there's a video, and get your tax questions ready next week for another session. This is Simon Misiewicz from Optimise Accountants. Have a fab evening. Bye-bye.